Imagine that you're up 50% on a trade and you think you're going to cash out big and take home some profits, only to find out that once you do decide to make that trade to cash out, you actually lost 10% of your investment. How does that happen? We're going to find out. Welcome back, everybody, to Life Changing Wealth. You know who it is. It's your boy, Jay Biondo here. I post videos every day about the stock market, cryptocurrency, and real estate. And today is a hot one. We're going to talk about how to become a better trader. And more importantly, we're going to talk about what is an order book. We're going to explain it. We're going to talk about margin trading a little bit. And we're going to talk about really tips on how to avoid problems with an order book when you're making trades. A lot of you guys might not even know that this exists, but it is so important when trading that you sort of have to understand what an order book is and how you can use it to your advantage to make the most money. Because otherwise, if you don't use it, you could actually end up hurting yourself and losing money. Okay. So, to give a framework around this topic of what an order book is, the first thing you have to understand with cryptocurrencies or equity investments when you're on an exchange is that it's an auction platform. So, you might not realize this. You might go to you might be using Coinbase now and go over to Coinbase and think, okay, well, that's the price of the crypto. I'm just going to go ahead and buy it. Boom. Or you might use another trading platform like Robinhood and see the price and just be like, oh, that's what it is. I'm going to buy it. Not realizing that it's actually an auction-based system, right? So you have buyers and sellers on each side of that market. And so because it's an auction-based system, you have what's called open orders, okay, or limit orders, okay, and these. So imagine you had. I'm just gonna throw out an example to try to have you understand this sort of concept of investing, and that is imagine you had, let's say, a bottle of water, okay, and currently somebody was willing to sell it to you for $1, okay. And another person was willing to sell it to you for $1.20, and another person was willing to sell it to you for $1.50. Well, who are you going to buy that bottle of water from? You're going to buy it from the guy that is selling it for $1, okay? But after you buy the dollar, who's left in line for the other people to then place their orders, right? Well, the next in line is that $1.20, and then if that bottle gets sold, then what's next in line? The $1.50, and that's sort of how you can see that the price would move up. It's really supply and demand based, right? So imagine there's 1,000 bottles being sold at $1, 10 bottles being sold at $1.50. Well, it's going to take a long time for us to buy 1,000 water bottles, so the price is going to sort of maintain at that level. All right, so that's just sort of a real rough framework, but let's dive into a real world example so you can see sort of exactly how this plays out. Okay, so this is my account. You can't see my information, but this is on my Kraken account, and I wanted to go through this with you to show you some real use case examples. Okay, so Bitcoin right now, this is what we have pulled up. We have the chart on the left. We have the order book in front of us. Okay, and on the order book, we can see that the current price is at $68,600. We can see that other people above it are willing to sell. There's 130 Bitcoin. It's fluctuating. The price is constantly changing, right? Because it's an auction. People are willing to sell it if the price gets to $69,000. And then we can see that there's 335 Bitcoin willing to be sold if the price gets to $70,000, okay? So if somebody wants to go in and buy up 500 Bitcoin, the price is going to rally up to $70,000 because that's the supply pool that's available right now. And you can adjust this so that you could do it in $2,500 increments to see how you would be affected, right? Because if you're only buying, let's say, 1 Bitcoin, you're not going to affect this. You're not going to affect the price much. And affecting that price is a process called slippage. So the greater slippage you have, the greater impact the price is going to have. And the larger quantities you buy, really the more impact it's going to have on price. And really what it comes down to is you need to make sure that there's enough liquidity in the market, right? So more liquidity, less price impact. Less liquidity, lots of price impact, lots of slippage. So if we zoom out, we can get a more granular look here and break it out to $50 increments, right? We can see that if I was to go in and buy 30 Bitcoin right now, it bumped the price up to $68,800, okay, on this exchange, because that's all that's available. So the real question is, how can you get fucked? Well, we're going to talk about that. So imagine this scenario where you borrow money. You buy on margin, right? You borrow money from the exchange. So let's say we're doing 5x leverage, right? We could go up to 5x leverage, and we're not gonna get into all these little idiosyncrasies of how you can do different types of trades. That'll probably happen on other videos. But let's say you borrowed money. Let's say you had $200,000 invested in Bitcoin, and you went in on a 5x leverage. Well, now you borrowed $800,000, so you went in on $1 million trade. Okay, $1 million trade. And this isn't a great example of Bitcoin because Bitcoin has a lot of liquidity. But imagine you did that on another currency that isn't so liquid, like Cardano, like Polygon, and it really, and you go down the chain. The smaller the crypto, the less liquidity it has, right? So now you go in with $1 million trade. You're going to have an enormous price impact. You're going to have slippage. So let's say you make the trade, okay? Then you're up. You're up substantially in your 5x trade. You're up 10%, 20%. If you go to sell that, and there aren't enough buyers in the green here willing to if there aren't enough buyers or enough almost like coins or shares in the pool, you're going to drop the price. You're going to tank the price. So if the price was $10 and then it goes up to $12, but you're selling $1 million worth of it, you might tank the price down to $8, which means your average selling price is now $8. You actually lost $2. And that's the importance of understanding the order book and its impact on price. So sometimes if you are using big quantities of money or the pool of money is very illiquid, okay, sometimes it doesn't even have to be that much money. It could be $5,000, could be $2,000 if there's just not a lot of liquidity in that market. You're going to have massive impact on the price, and it's going to drop your profits substantially. So you just have to keep that in mind when you're using an exchange. And that's also why it's important that you want to be on an exchange that has a lot of liquidity. This is sort of the disadvantage of using smaller exchanges as well, is that you miss out on liquid pools, right? So that is the sort of overview of what an order book is. It's an auction system. It shows you what the orders are available, who's buying, who's selling. These are the sellers in red. These are the buyers. This means that people are willing to buy it if the price drops to 68,300, right? There's 26 people that have put it in order. If the price drops to that, their order will get executed and they'll make the purchase, okay? So that's how that works. And this is a visual representation here on the left of how many orders are outstanding. So we can see here that if there was a price disparity, okay, like the price were to go up 10% or down 10%, up 10% or down 10%, there would be more orders filled if the order went down 10% versus if it went up 10%. So it gives you kind of sort of an example of where the market's moving. And when you see big notches out like this, you can see that that's somebody placing a big order, or that's somebody that believes that that's where the price floor is going to be on the next drop, or the next top being up here at 69,000. So that's where people think a lot of resistance is going to be. That's the overview of the order book. Yeah, so that's just sort of the quick analysis of the order book. And we're going to cover so many more things. This is just one frame of reference that I wanted to give you guys. I wanted to give you guys a tool so that you understand when you're buying on Coinbase, you're actually impacting the order book. It's behind the scenes. You don't see it, but that's what's really happening. And the same goes for Robinhood or other applications that you use. Think about these order book trading strategies as you make your trades and if you're going to impact the price. So that's what I've got for you guys. If you enjoyed the video, make sure you hit the like button, subscribe below as well, turn on that notification bell, and check out this other video right here, which is going to tell you really more tips, more trading tips just like this if you enjoyed the content. I'll see you guys in the next video.